Welcome back. You're watching Stockwatch with me, Simon Brown. Joining me to take your stock-related questions tonight, Wayne McCurrie from F&B Wealth and Investments and David Shapiro from Sasfin Securities. Be sure to send your questions. Email stockwatch@bdtv.co.za or via SMS 41392 or on X, Twitter. Use the hashtag StockWatch. Wayne sneaks in just at the right moment. Gents, evening. Thanks for joining us. I want to start local. We had the inauguration of our president today up in Pretoria. So now we've got an official president. We had a storming day on the markets yesterday, a less storming day today. Wayne, let's start with you around the rand. Trading around 18 rand to the dollar. Whenever I chat with you, you've got a sort of fair value. What's the fair value and where could this rand go?
The fair value is about between 17 and 17.50. But if past trends are the same into the future and we do once again, stuck record, get a commodity upcycle, the rand normally overshoots and goes into expensive territory. So the rand could well go below 17 in the next 2 to 3 years if we get a commodity upcycle, which we hopefully do get. And just on the market and on the rand, I think there's two factors that people must take into account. First of all, our domestic shares, SA Inc. shares, went up because they were cheap. The rand strengthened because it was oversold. The GNU and the state president being voted in, these are trigger events. They're not the reason why the market went up or the rand strengthened. They're just why it happened on this day or over these 2 or 3 days.
I take your point. It was waiting to happen, and we've got a bunch of cheap there. A great question, Wayne. I'm going to stay with you for a moment. Gareth was asking. He says he's building a portfolio. He's got some offshore. He's got some local. What would a split be between local and offshore with a sort of 2 to 3 year time horizon out? I mean, is there an ideal number to say keep X in ZAR on the JSE where we've got cheap, and put Y amount into US dollar where we've got expensive, but I mean, don't stand in front of NVIDIA.
Okay, look, over long time periods, ignoring cycles, in other words, ignoring a commodity cycle or whatever, over long time periods, you probably want between 60 and 80% of your portfolio exposed to non-rand SA. It doesn't mean all your money, all that's got to be overseas. You can get a lot of non-rand exposure on our JSE. In fact, our JSE is probably 70 to 80% non-rand exposure, taking into account that the commodity companies, even though they might be in South Africa, actually earn in dollars. So that would be ideal right now. I mean, you all know my stance so well now that, we could get a commodity upcycle and the rand could strengthen and the commodity shares and SA Inc. shares could do quite well on a 2 to 3 year basis. Maybe you would like that a bit lower, maybe between 50 and 60%. But over time, honestly, you would want 70 to 80% of your portfolio of non-rand exposure, not necessarily, as I said, overseas, but not exposed directly to the South African economy.
Yeah, and there's tons on the JSE. I mean, Richmond springs to mind. David, is there an argument to be saying that maybe we should bring some dollars back, or is that trying to be far too fancy?
It's too early to make that decision. I'm with Wayne in the sense that this has been triggered by a good outcome of the election and hope and optimism that things will start coming right here, that we'll work towards where we should have been probably 30 years ago. But I think after that, you're going to get the other trigger, which is going to be rates coming down in the United States. They are going to come down. We're going to see them coming down in Europe. And that's going to be another trigger, which could shake the dollar a little. Those markets will be strong, but I think the dollar could come down, which is going to give, I think, the rand another boost. So don't write off a rand at 17 or, even lower than that. We can see that. And very soon, just see how fast we got from 1880 to 18, just a click of fingers. And that's how those markets work. So I think we're in for a very exciting couple of months. It's very difficult to decide whether you stay at home, whether you go offshore, whatever it is. Don't write off US markets as well, where we're starting to see upgrades there as well about where the S&P is going to be. So, you're going to have a choice where you can actually put your money.
So, Wayne, David, let's stay offshore for a moment. Nvidia, one I know you like, became the biggest stock in the world yesterday, although it's tight at the top there between themselves, Apple and Microsoft. I mean, if any little finger trouble and suddenly one of them isn't. James was asking me on Twitter. He asked two questions. The one, he says, semiconductors and AI, taken that this is the future. We know Nvidia. What else out there that is building the infrastructure? And what comes to my mind is like ASML, TSMC. What are sort of I suppose the shovels, although truthfully, to a degree, Nvidia is a shovel too.
You know what, Simon, it is so big, because if you look at a data center, even the data centers which are now being built to accommodate this high level of chips and processing, they're calling them factories now. When you put that factory up, you need power, you need cooling, you need wires, you need everything. So there's a very big and wide supply chain around it. My choice is just to stick to the ones I know, which are the big ones, the ones that you have mentioned. I don't think at this stage we need to go beyond that. If you're feeling uncomfortable about Nvidia at these levels, I've been recommending the SOX, which is the semiconductor ETF, which has got 10% of Nvidia in. It's got AMD, it's got Broadcom and Qualcomm and TSM and all those in. So you get a complete basket. So there's plenty of choice there as well. But you don't have to go, don't keep repeating it, because a lot of the companies are very similar.
Yeah,
so there's still lots of choice, yeah.
I actually saw a report, I think, early this year, which was saying buy HVAC companies because they all need cooling, and nothing has happened there. James is also asking about luxury. Wayne, if I can come to you. He says, is luxury going to become more popular as rates come down? I mean, particularly in South Africa. In the US, your mortgage is typically a fixed rate. But as rates come down, people get a little more money in their pocket. Does that give a potential uplift for luxury?
Yes, it could be, but the biggest uplift will be on the shares that are bombed out.
Yeah.
The luxury shares haven't been destroyed at all during this down cycle. So yes, they will benefit, but the biggest beneficiaries will be the FMGC type of companies, the financial services, the banks, because the shares have been beaten down. So yeah, that were the biggest share price beneficiary, although obviously, as I said, the luxury goods, their earnings will benefit from this. But most of the people who buy the luxury goods aren't that swayed by interest rate. Ask Shapiro.
I'm smiling because there was a report today out by Ferrari. They've just released their all-electric vehicle, 500,000 euros. Now, Wayne's clever because he can times 500,000 euros times, 22, 23, or 20, so it gives you an idea of how much these cars cost. And there's a waiting list, just in case you've got any idea of buying one. Just stand behind everybody, because you're going to be long in the queue, to get one of these things. So that's the luxury market.
Hey, they also won the 24-hour Le Mans this weekend. Not the electric one, but the Ferrari did. So, and they have the best code on the market, race. I mean, who doesn't want to be race? Let's come back to local. A question coming from Fritz. He's saying, City Lodge, good 3 trading days. Yeah, up 15% in the last week or so. He says, a bit of an enigma to me. They've been releasing positive news, occupancies, refurbishments, buybacks, dividends, etc., etc. Shares struggled to break R5. David, what about City Lodge? I mean, I was looking at all of the leisure stocks. I mean, Sun International is off the recent highs. Southern Sun doing a bit better.
You know what? City Lodge is City Lodge. You go there and you eat out of vending machines. It was really designed for business travel. And I think the post-COVID the recovery has taken place. Occupancies are up to the certain level, etc. So I think it's hard for them to compete with the Sun Internationals and the more leisure type hotel groups where you're getting more tourists. I don't think City Lodge was ever designed for something like that. It's still a good company. They're doing well. But if you want to, gear yourself to hospitality and the increase, I think it's more the other groups that are going to benefit. And also they've got the gambling side of it as well, which City Lodge doesn't have.
And David,
unless you've got a slot machine there in the foyer, I don't know. Maybe they've introduced that.
David, you haven't been to a City Lodge in an age. They've done away with the vending machines. They now have food and beverages. Actually, they probably still have the vending machine, but they've also got a food and beverage now as well. Wayne, in the leisure space, I mean, if we look at South Africans a year out with inflation lower, let's say interest rates 1% down, we want to travel. Some of us will be going to Zanzibar, some will be going to Gqeberha. Is there opportunity in the leisure sector?
Yes, I think so. And I mean, the shares don't look expensive. City Lodge itself, it might not have the greatest outlook in comparison to the other companies in this sector, but it's not badly valued. I wouldn't get massively excited about it. I think there are better opportunities. But it's not a bad company and it's not badly valued. And I mean, just anecdotal evidence. You fly anywhere, there's no seats on planes there. Planes are chock-a-block.
Yeah. I'm trying to book flights at the moment, and the ticket prices are frankly eye-watering. We might do our holidays in holiday in Josie. MultiChoice. Sandila is saying, had the stocks in 60 to 70 bucks. Sandila, congrats on that. Confused. Yeah. Should he hold for the 125? The stock's been going down a bit recently. I mean, when this will conclude, it's just going to take some time. I think they said they hope to conclude the deal by April of next year. Now it's just time value of money.
Yes, and I would take the time value of money. I would take the 100 Rand now where it is now. Because this last set of results, I mean, I thought they were just kitchen sinking it because of the takeover, but I was set right by another commentator. This was truly an awful set of results.
I mean, David,
truly an awful set of results. I went and had a look at it again. It was terrible. So you just sincerely hope and pray there's no exceptional circumstances clause in the agreement with Canal Plus, because this share, I don't know, go to 40 Rand, 30 Rand if there's no Canal Plus deal going through, 50 Rand, I don't know. But this was, and the company's technically insolvent. I mean, this was an absolutely awful set of results.
It was.
Wayne's right.
Yeah, David, it was horrid results. I didn't realize it was down at $100. I mean, the offer's 125. Would you take the 100, David?
You know why? Because there's lots of opportunities. You can take the 100 and you don't have to wait until April. We're going into a very strong market, as you've seen the last couple of days. So don't lose the advantage, or don't lose your flexibility by saying, okay, I can make it up somewhere else. Wayne's right. I don't know if there are any clauses in which can allow Canal Plus to pull out of it. And the fact that MultiChoice entered into a deal, to sell part of the insurance business to Sanlam, to raise a certain amount of cash, just shows you how short they are, that they're going to go into these kind of deals just to prop up their working capital. So, yeah, it's quite a scary number. The numbers that came out are quite scary. Take the money and run. Yeah,
okay, $100. $100. Wayne, a question coming through for yourself. You've been saying banks are cheap with the rally over the last 10 days, and it has been a massive rally over the last 10 days. There's still some value there, or is it time to take some profits? I mean, I don't know what the price to books are, but they're probably only at about one, if at most.
Are you just on banks now?
Yeah.
No, I think there is still some more upside. Yeah, I mean, obviously, like First Rand's up 20% in 7 days here. There is still some value to be had there. But on our overall market, I mean, despite the big rally that we've had now and hitting record highs, etc., there's still a decent amount of value left in our market. And there, the most of that value, in my view, sits in the mining shares. But I think there is still some value in the banks. But remember, no one's ever jumped off a building because they took profits too soon. So if you've made a nice 15, 20% return on your holdings, sell off that excess, bank it. Why not?
Yeah, no, I take your point. David, I mean, the banks, they've rallied hard, but, they're well capitalized. It's a tough economy to grow, and we appreciate that. That's not going to change on a dime. But I mean, there's still also, I mean, those dividend yields are, I don't know, they were approaching 10. Maybe they're now 8 dividend yields. It's a giant number.
You've got to appreciate that, because as rates start to come down, as we start to sell off the long end of the market, and rates come down, etc., it makes dividend yields a lot more attractive. So you get, people forget that. So I think that, look, banks are back where they were in 2019.
Pre-COVID,
Yeah, it's taken 5 years to get back to where we are. So they're not excessively expensive. But I think you've got to look at those dividend yields in relation to where you think interest rates are going. And we're going to break. I know I saw the inflation number out today. It's still in the high level, etc. But once we start to break overseas, once they start reducing rates will come down here as well, which is going to make high dividend yields a lot more attractive.
Yeah, no,
that's going to be my stock pick as well, because I don't want to preempt it, but I think that if you start to look at property in the same light, and bonds in the same light, it does make them very attractive.
Stay local. Another question around whether Dis-Chem is worth having a look at current levels. And I'm going to add to it, Dis-Chem versus Clicks. I've always sort of preferred Clicks, but Dis-Chem's always just looked expensive to me. David, let's stay with you for a moment. Your take on Dis-Chem.
Look, they're working their way up. I like the business. I'm not that familiar with their policy, or not their whole expansion plans, etc. But I feel comfortable when I go into a store. I find whatever I want, and I'm always impressed with the people going in there. It's all old timers like me going up to the prescription counter, and they always come out with something else. So I prefer a Dis-Chem store to a Click store, but you can't ignore where Clicks are around the country. So I'm quite happy with both. I think Dis-Chem's slightly cheaper than Clicks at the moment.
I prefer Clicks. My big gripe is you go there to buy healthy stuff, you stand in the queue to pay, and they sell you sweets, which are not healthy at all. Wayne, Dis-Chem versus Clicks, either, neither, both?
Yeah, look, they're both about the same valuation, which I think is on the expensive side. I think there's better opportunities to be had somewhere else, obviously. But I mean, they're very good companies over the longer term. So if you do get some share price weakness, you must buy some. And I must say on Dis-Chem, I do concur with David there. You go into Dis-Chem, people always look happy. All of David's compatriots shopping at the shelves there and at the pharmacy, always look happy.
Okay, so there's
They sell those big buckets, the big buckets of stuff that put muscles on you, etc.
Yeah, I see those as well.
You can't get that at Clicks, all those powders and that.
I'm not strong enough to pick up those buckets. Those things are like 20 kgs of whatever they might be. Wayne, what about Investec? We talked banks, and I think when we talk banks, typically we're talking the big 4, 5, which brings in Capitec. Is Investec in that pile as well?
No, Investec's not really in the same. You can't really talk about them as being the same. But Investec's done a very good job. The new management there has actually done a very, very good job in turning the company around. And I mean, to my, not to my credit at all, I went to a lunch given by the new management. This is pre-COVID. And they just said, simply, if we can just get the ROE up, the return on equity up a little bit, and return on assets up a little bit. And they've restructured this business quite significantly. They closed quite a few areas. They've really sharpened the business up. And this share's done exceptionally well over the last 5 years. I mean, just looking at the chart here, it's up 120% in 5 years. And that's taking it from the pre-COVID level. Other banks are now, as David said, just back at the pre-COVID level. And yet it's the same pricing as all the other banks. It's a 6% dividend yield. It's an 8, 9 times PE ratio. So I still think it does show value. And, all credit to the new management there who've actually done a lot to turn the company around.
Yeah, they really did polish it a whole bunch. Right, next day with you, capital appreciation, small little penny stock in the sort of fintech and terminals and the like. Is any opportunity there? They had some numbers out recently. They passed R1 billion revenue for the first time ever. They're kind of plugging along. They're in the right spaces. Small caps like that, is the opportunity here? David, I see you nodding excitedly.
Oh, sorry, I thought you were talking to Wayne. No, it is a very neat. They're exactly in the right kind of areas of the market, whether it's in the cloud or whether it's those terminals that you find at retailers, etc. So one doesn't understand what goes behind those terminals as well. So I think there's all fintech. So I was a bit surprised because I thought the last set of results were really excellent, but obviously there was something that held it back, and the share price just seems to be going sideways. But it's watch it. It's a small business, but I think well run with a nice with kind of decent operations within it. I'm in the middle.
In the middle. Wayne, are you either on the non-middle side in capital appreciation?
Look, I'm not, generally speaking, a big fan of small cap shares. The price can be so variable because there's no trade on it. And whenever you look at a share price chart, over a shortish time period, and you see a Manhattan, always worries me.
Yeah.
And that, unfortunately, you do see with small cap shares that don't have much trade. But I do concur with David. The last set of results were actually very good.
Yeah.
It's a good set of results, nice cash flows, big increase in profitability, margin enhancement, nice dividend increase, and it's trading at a 8% dividend yield. So maybe if you want to put some money into it and live with the volatility that a small cap gives you, why not? I mean, honestly, it looked quite good.
They've got to break out of this range. I was just looking at the chart while Wayne was talking. They were 200 at one stage when Wayne says a Manhattan, that looks like a Manhattan skyline. And I think this is a share, even that's what I said after the last set of results, they just bumbled sideways. So I said, okay, what am I missing? What's the market know that I don't know? And that's always that's why I'm saying a bit indifferent at the moment. I'd like to see them break out of this range. It's a pity we can't show the chart just to illustrate what we're talking about, and maybe the next set of results or results down the line might give them that lift out of this sideways track.
Okay, let's go to some stock picks. David, you've hinted at yours, so I'm going to come to you last way. Next, start with you for your stock pick. Sasol. Even Sasol's responded to this SA Inc. rally.
Yeah, there was a lot of negative news, obviously, about SA, what's going to happen if the MK, ANC, EFF get together. And so a lot of this rally that we have seen, it's only back to where it was, a month ago. So, it hasn't exactly shot the lights out. But, if we get same story, get a global economic recovery, get a recovery in the oil price, which obviously some of it will be taken away by the stronger rand, but the big recovery in global chemical prices. This thing's trading historic 3 price earnings ratio.
Yeah.
It's really cheap. This is not, it's not for sissies, this share, but it can recover strongly. So, I think you can see 200, 250 rand here in the medium term quite comfortably.
Yeah, we are seeing some positive moves higher in global chemical prices. Early days, but we are. David Shapiro, Sasfin, you're going with some South African government bonds.
I still think, if you can lock in, and I'm talking those that are beyond 10 years or 8 years, where I know rates have come down on the short, or when I say the 8-year bonds or whatever it is, but those that are longer, if you can hook in, 11.5% in the kind of environment now, go for it. Because when those rates come down, there is a little bit of a capital profit you can make. But I think, that's what I'm saying with dividend yields as well. If you can lock in those high dividend yields, do it, if that's what you're after. And I think the same with property. You're going to get some very attractive opportunities in the property market if this is real and this continues, which I believe it will.
Yeah, I take your point. There's also the RSA retail bonds, which is fixed for 5 years, 11.5%. That rate will change in July, but 11.5 it's a chunky. 5 years at 11.5 is a big number. Make no mistake. We'll leave it there for this evening. That's all for tonight's Stock Watch. Thanks to our guests, Wayne McCurrie from FNB Wealth and Investments. He went with Sasol. David Shapiro from Sasfin Securities, going with South African government bonds. Up next, the close. Stay with us.
Thank you.